Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Walgreen stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a mid-cap company, 9.5 billion market cap. They're trading at $11 a share, and they have 860 million shares outstanding. Walgreens Boots Alliance is a healthcare, pharmacy, and retail company in the US, Germany, the UK, and many other countries. It was founded in 1909, headquartered in Deerfield, Illinois. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Free cash flow looked really good in 2022, 2.2 billion. You can see revenue was lower than the following few years, but their free cash flow is going down a lot. Expenses are going up, and they're getting squeezed out of the market. They actually had negative free cash flow in 2024. They did have positive in the trailing 12 months, but only 600 million, which is really low for this company. 150 billion of revenue. That's more than 99.999% of the companies out there. Net income is the profit or loss on the income statement. It's revenue minus expenses. 4 billion in 2022, but negative after that. Lots of write-downs, lots of asset impairments. Revenue is a sales for the company, and that looks really good. 133 billion to 152 billion. Unbelievable amount of revenue. And they pay a 9% dividend, which cost them $860 million, but they can't afford it because they only generate 600 million of free cash flow. They could only afford 70% of their dividend payment. So they're going to have to cut their dividend. It's just a matter of time because I don't think they can bring their free cash flow up that quickly. It's going to take them another few years to do that. We estimated 4 years of future free cash flows. We also estimated the terminal value. It's all cash flows past year 4, that's 16 billion. We discounted those numbers back to today using weighted average cost of capital. We get a value of the company of $14 billion. We divide that by 860 million shares. And we get a calculated stock price of $16. They're trading at $11, so they're trading at a 32% discount. It's a buy according to the model. I'm assuming their free cash flow stays low and it's only 1.2 billion by 2028. Even if they hit these low targets, they still seem undervalued. But if they get back even close to 2.2 billion, the stock should be 30 or 40. If they get back to their olden days when they were north of 5 billion, the stock should be 100. There are 5 companies in the same industry as WBA, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend the most in CapEx of 1 billion. They operate retail stores, so that when they open a store, that's a CapEx spend. Lots of leverage, lots of debt. Debt to equity ratio 4.2. Look at that dividend. They're the only company that pays a dividend in this industry. They generate a lot of free cash flow, most on this list. This should be highlighted yellow. Biggest company by far on this list, but it's not that big, under 10 billion. It used to be a lot bigger. Price to book at 1.3. We can't look at that PE, negative earnings. They're trading at 17 times free cash flow. Look at that price of sales, 0.1. When a price of sales is below 0.1, the company is really, really efficient or headed towards bankruptcy. It sounds odd, but it's usually one or the other. 150 billion of revenue. They're probably in the top 20 of all the companies in the world, maybe the top 50. Their 5-year annual revenue growth rate is positive 5%. The other companies are negative. And the stock price is $11, which is 32% above its 52-week low, 41% below its 52-week high. So it's closer to its 52-week low than its high. If you put $10,000 into this company 10 years ago, which a lot of people did do, and reinvested the dividends, you'd have $1,900 today, an 81% loss. So to summarize, I have them trading at a 32% discount, ranking 8 out of 10. I think it's a really good short-term and long-term trade. Actually, I'm going to make it 10 long-term, 9 short-term. I'm pretty sure this company's not going to go out of business, and they're going to be around a long time, so it's definitely going to go up in the long term because it's so low right now. Ratio is 4 to 10. We can't look at their PE. And their others are pretty average. Their price to sales is really good though. Price to book and price to free cash flow is at the median. Financials 4 to 10. Even though their revenue is going up, their free cash flow isn't doing so great. Let's take a look at their 10Q. Here's their income statement. The 3 months ending 2/28. This is the current quarter. This column is comparing last year's current quarter. So the 3 months ending 2/29/2024. And these 2 columns are the trailing 6 months. Sales are up a little bit, 37 billion to 39 billion, just for the quarter, 39 billion of revenue. Let's see if they give a breakdown. Here's a breakdown of the 39 billion. In the US, they had 30 billion of revenue, 23 billion in pharmacy, 7 billion in retail. International, their Boots division, pharmacy 800 million, which is down. Retail is up a little bit, it's 2.2 billion. Then you have wholesale, 3 billion. That's up slightly. So their international revenue went from 6 billion to 6.1 billion. They also break out US healthcare. That's pretty much flat, down slightly, a little under 2.2 billion. The US healthcare segment consists of Village MD. That's a provider of primary, multi-specialty, and urgent care. Also, Shields Health Solutions. That's a specialty pharmacy and accelerator for hospitals. They have CareCentric also in this segment. That company is a post-acute and home care management company. Also is Walgreens Health. That's an organic business that contracts with different participants in the healthcare ecosystem to provide commercial and clinical healthcare services. Let's go back to the revenue breakdown. Below revenue is operating income by segment. Most of it is from their US retail pharmacy, a little under $500 million. Then you have international 200 million, US healthcare 117 million, and corporate and other is the overlap. So they minus that out here. Because certain revenue and expenses are in multiple categories, so they have to remove it here. Let's go back to the full income statement. Below revenue is cost of revenue. These are all the expenses directly tied to generating the revenue. That includes rent for the store, payroll, the cost to buy products. Revenue minus cost of revenue gives you your gross profit, which is down. Their expenses are going up faster than the revenue is. It was over 7 billion last year, now it's under 7 billion. SG&A, selling general and administrative expenses, that includes marketing, 9 billion. That's up quite a bit from last year. Impairments, that's why they have negative income, all these impairments. Last year was 12 billion, now it's 3.7 billion. This is when you write down the value of an asset on your balance sheet and pass through the loss onto your income statement. A really popular impairment is goodwill impairment. That's when you pay a premium for a company, when you acquire a company and pay more than it's worth. So you carry that on your balance sheet as goodwill. Then if the acquisition doesn't go as planned, you don't make as much revenue as you thought you would, then you decrease the value of that asset on your balance sheet and then pass through a loss onto your income statement. So it's a non-cash item. Because say 5 years ago you bought a car for $20,000, and according to your personal balance sheet, the car is worth $5,000. That's the book value. That's how much you could sell the car for this year. And let's just say the car was totaled in a crash, so it's worth nothing. Then you would reduce the $5,000 from your balance sheet and pass through the loss onto your income statement. But it's not like you lost $5,000 in cash. You paid for it 5 years ago. So if it got totaled this year, you wouldn't have to pay anybody $5,000. It's an accounting thing. I think that's a pretty clear explanation, but we could talk about it more in the comments if you're interested. So their net loss was $4 billion. Last year was a net loss of $12 billion. You can see they're adding shares. Last year, 862 million, now 864 million. Let's take a look at the balance sheet. This is as of 2/28. This is as of 8/31. Assets, 70 billion. That's down from 80 billion. Current assets, these are assets that can be liquidated into cash within 12 months, 16 billion. The most liquid asset is cash itself. That's a definition of liquid, cash. Marketable securities is almost cash. You can easily turn it into cash at any time. Marketable securities are highly liquid investments. It could be stock in a company, treasury bills, funds in a money market account. Because stock is pretty liquid. You can sell your stock anytime the stock market is open. It's a very liquid asset. Of course, it could go up and down a lot, but you can sell it very easily. A house is not liquid. Even though it has value, you can't just turn it into cash right away. Even if you find a buyer that's all cash, it still would take a week, possibly a month, possibly multiple months to sell the house. There's a lot of paperwork. You can't just sell it right away like a stock. Accounts receivables, this is how much money other companies owe them when they sell on credit, 6 billion. Inventory, they always have a lot of inventory in their stores, 8 billion. And their biggest asset is operating lease right of use assets. These are assets that are owned by another company that they lease, 19 billion. Goodwill, 12 billion. That's a premium you pay when you acquire another company. Intangibles, like patents and trademarks, 11 billion. Their total liabilities is 63 billion, down from 69 billion. Their biggest liability is operating lease obligations. This number is related to this number. This is how much money they owe on these assets. Equity is the value of the company according to the balance sheet. Assets minus liabilities equals equity, 7.2 billion. They raised $10 billion from selling their business, selling stock, that's paid in capital. Retained earnings is how much money they profited from running their business. That's the sum of all their prior net incomes minus the sum of the dividends they paid out. And treasury stock is the amount of stock they bought back. So when a company buys its own stock, the stock is removed from the open market and it's put onto the balance sheet as treasury stock. That's a contra equity count. It brings down your equity balance. And the statement of cash flows, this is for the trailing 6 months. You can see that cash flow negative, which is not good. Last year, a cash outflow of $900 million. This year, a cash outflow of $300 million. You see you add back that impairment, that $5.66 billion. This $5.7 billion, you'll see that in the income statement. The second section on the statement of cash flows is investing. They had a cash inflow of $340 million. They spent $500 million on PP&E. They may have acquired some more stores, and they sold $769 million of assets. This could be their marketable securities. Lots going on in the financing section. They added $15 billion of debt. They paid back $16 billion of debt. They paid $430 million of dividends. Last year was almost double. Let's look at them on Simply Wall Street. Its last price, $11, $9.5 billion market cap, up 1% in the past week. Not so good in the past year, down 38%. Here's the stock price since the early 90s, 1990. That was the lowest point ever. This is stock split adjusted, $2.68. You can see it ran up right before the dot-com crash, over 40, and then came down to 30, then ran up again right before the Great Recession, almost 50, then came down to the 20s, then ran up again to 2015, its highest ever, 96. And the market came down quite a bit in 2015, 2016. It went from 95 down to 65. This article talks about it a little bit. The 2015, 2016 market sell-off, one big reason was a Chinese market turbulence. The Chinese market fell 43% in just over 2 months. Greece defaulted on their debt in 2015. There was a sharp rise in bond yields. And in 2016, UK went through with Brexit. Brexit, the British exit from the EU. It bottomed out in June 2018 in the low 60s. Then by the end of 2018, it came back up to the low 80s. But it started coming down well before COVID. It went from the low 80s to the 50s. Then COVID came and it got to a low of 37, it looks. And lots of stocks reached their all-time high sometime in 2021, that COVID post-rush. This stock went up, but not that much. It peaked at 57 in 2021, but since then, it's fell off a cliff from 57 to 46 to 33 to 22. And the stock does go up when it bottoms out, but then it hits a new low. The bottom was $8.25 in September. And it's up a little bit since then, not that much. It did get up to 13 in January of this year. Now it's sitting at 11. So $11 is where it was trading in 1997. In 1997, it was $11.66. So it's getting close to a 30-year low. Seems like a great time to get the stock. Simply Wall Street's valuation is 19. They say the stock is 42% undervalued. 12 analysts priced this stock at $12. They say it's slightly undervalued. Their revenue projections are $157 billion by 2027. 7 analysts are projecting their future revenue, and the average of those 7 is $157 billion. In terms of free cash flow, 2 analysts are projecting $850 million. This is the average between those 2. The projection for this year, August 2025, is negative $379 million. Here's their revenue since 2014. It was $75 billion. And it went up a lot from 2014 to 2019, $137 billion. Then it was pretty flat for a couple of years, and now it's been moving up again. It's at its all-time high, over $150 billion. Here's their debt since 2014. It was $4.5 billion. The highest was in 2017, $19 billion. They must have did a big acquisition in 2017 to get that high. In 2015, they paid $9.5 billion to acquire Rite Aid. But that deal did not go through, as you can see here. Instead, in 2017, they paid $4.4 billion to acquire 2,000 of the 4,600 Rite Aid stores. So that debt is due to that acquisition. Here's their equity since 2014. It was $20 billion. The peak was in 2021, $33 billion. But now their equity is a little lower than their debt. And it's the first time in a long time their debt is higher than their equity. You can see they were raising their dividend pretty consistently from 2015, 34 cents, to 2023, 48 cents. But then they cut their dividend. They reduced it to 25 cents. And it's been 25 cents for the last 4 quarters. And the yield was over 10% in November, but when they reduced their dividend, the yield fell to 2.3%. And the forecast is 7.5% by 2026, 7% by 2027. 63% of the company is owned by institutions, 20% by the general public, and 17% by private companies. Their biggest shareholder is NewSip, 17%, not familiar with this company. Then Vanguard, 10%, BlackRock, 8%, Goldman, 1%, and 8 Knots Management, 0.4%. Their employee count was almost 370,000 in 2015, and then it came down to 300,000. Here's some info on employees. This is from 2015. 360,000 people, 115,000 were part-time employees that worked 30 hours or less, and now their employee count came down to 250,000. Looks like they closed a bunch of stores, or maybe sold one of their divisions. And the ticker trades on the Nasdaq Deutsche Börse Mexican Bolsa, the Xetra London Stock Exchange, Wiener Börse, Borsa Italiana, the BATS Europe, and the Buenos Aires Stock Exchange. So if you want to get a copy of my discounted cash flow model, click on the video in the top right corner.